Hello everyone, my name is Jonathan Wu, Chief Investment Specialist at Premium China Funds Management. I'd like to give you an update today on this current state of Asian fixed income markets, as well as the current opportunity set available, in what is ultimately a very bizarre world, where rates or yields continue to decrease, while the thirst for yield continues to increase. As you can see, sub-zero bonds now make up a very material portion of the market at about 20% or over. And if you then consider the portion of the market that's actually paying over 5%, it's actually less than 5% of the whole market. Furthermore, if you put this within context, Austria recently issued 2 billion euros of fresh sovereign debt paying 0.88%. Although that 0.88% isn't necessarily a surprising number given the current environment, the tenure of this debt is very surprising. It was issued at 100 years. Investors are putting a lot of faith into these types of investments, given the fact that they are assuming over the next 100 years that there isn't any increase in inflation or an increase in rates. Because as we know and learned from history, if there is an increase, a material increase in rates, the capital values or the face values of these bonds will fall. So given the current situation, where do we see investment opportunities? As we noted earlier in the month, China home sales have been strongly recovering, and for the month of May was positive 9.3% compared to May 2019 in a pre-COVID environment. Furthermore, in June it hit positive 10%, which reflects our view and reinforces the view that China is in a V-shaped recovery. And on the back of that, we have then allowed this philosophy to then flow through to our underlying portfolio, where we hold a material and almost half of the portfolio within property developer names. But more on this a bit later. The US market, as you can see, is severely overinflated, both from an equity standpoint as well as bonds also rallying. What you can see there, especially as the cumulative increase of new COVID cases in the United States continue to rise, bond yields continue to fall, represented by the purple line that you can see, which is the 10-year US Treasury yield line. So the question that many investors have is, at what point will this stop? It is all fundamentally based on the US dollar. If investors globally start to realize that the US dollar is no longer necessarily a safe haven nor a good storage of value, this will correct. And once it corrects, it will allow investors to finally realize that the market wasn't driven by fundamentals, but purely driven by liquidity and artificial inflation created by the Fed to effectively backstop any crisis that the market may face. So that is something that bond investors need to consider over even the medium term now, what that may cause them to do going forward to effectively reduce risk in your portfolios. If we consider the Asian market, on the other hand, Asian investment grade debt currently trades at a 100 basis point premium in terms of yield compared to the equivalent US investment grade debt market. Furthermore, if we look at the high yield market, Asian high yield trades about 200 to 300 basis points premium compared to US high yield, which then concludes that in a world where yield is so scarce, that the Asian fixed income market definitely creates an abundance of opportunity for investors that is searching for that ongoing yield. If we turn back to property, you'll also note that it is a very strong market and isolated from many external factors such as trade wars, as well as highly disrupted supply chains. It effectively operates in its own local domesticated ecosystem, which allows us to have confidence in their ability to be able to pay the coupons they have promised since inception, followed by their ability to repay the initial capital invested at maturity. The fund continues to be true to value, and for the year ending 30 June 2020, we paid out a total of 10.5% income distribution to clients. Furthermore, if we break this down, the first 3 quarters was 1.5%, followed by a bullet of 6% in quarter 4, which is made up of all the yield or coupons paid by bonds, capital gains made from trading of these bonds, as well as the closing off of a number of foreign exchange contracts which were hedging the US dollar back into Aussie dollar, where the average entry price was 58 cents and sold or settled at 68 cents. Generating a nice handsome profit for investors, which we then subsequently distributed out to them. If you then consider our distribution track record now, over the 9 years of the fund, we have over 35 observable periods where in each period we have never failed to pay less than 1.5% in income distributions out to investors, and it's something or a track record that we are incredibly proud of. So one of the key questions that both investors and advisors are asking us is how have we managed the portfolio well through this COVID-19 situation? Well, there's a couple of points to note. We have diversified the portfolio further, and we took the opportunity to do this post-March 2020 to effectively increase the number of holdings to around 50 bonds, but at the same time we have increased our concentration in our top names, which reflects our conviction in their ability to perform. If you consider the balance of the whole portfolio weighted, the yield to maturity sits at over 14% with a cash yield of 7%, representing the fact that on average our bonds are trading less than the face value of $100, and as they get closer and closer to maturity, you'll both participate in the coupon payments as well as potential capital gains. We have also adopted what we call a sandwich strategy. For a first time in a long time, we have allocated about 16% of our portfolio to investment grade debt. Now, the reason for this is because we want to hold some long duration debt, generally 7 to 10 years in length, which can help smooth out the volatility if we go through further shocks during this COVID-19 crisis. We then match this with the rest of the portfolio being high yield, and we generally have a portfolio maturity there of less than 2 years. So averaged out, the portfolio maturity is just over 2 years, which gives investors certainty and gives them confidence about being able to make both capital gains and income in the short to medium term. Now, this strategy will play out over the next couple of months, and it's something that we'll be monitoring very, very closely, as well as the level of hedging for the portfolio back into Australian dollars. So that's all for today, and if you have any further questions, please feel free to reach out to us.